The US Federal Reserve just injected $300 billion into the US banking network. The financial system is teetering. That's nearly half the amount the Fed lent out back in 2008's financial crisis. This is not normal. Credit Suisse, one of the world's largest banks, was just given a $3.2 billion bailout. Pay attention. The Fed, Banks of Canada, England, Japan, the European Central Bank, and Swiss National Bank all agreed to a joint liquidity operation. This is what happens when there is fear in the global economy. What does this mean for the stock market, and how should you trade moving forward? Let's break down the immediate impacts and then focus on 5 different things that you can do to optimize your trading in this type of environment. Voodoo economics are on full display here at the moment. The US Federal Reserve has long committed to raising interest rates and stifling any kind of quantitative easing. But now, after a sign of weakness, not only is Credit Suisse bailed out, the Fed flips its stance on easing and creates $300 billion for any bank that needs it, which translates to sometimes banks need more money that they have in their piggy bank. So they go to the Fed and borrow funds. The banks didn't have enough of their own money to pay back everyone that they had made loans to. So they went and got another loan to pay everyone else back. In doing so, nearly 4 months of quantitative tightening has been wiped out in 1 week. And remember, all that tightening was to try and tame inflation, and that job's still not finished yet. Plus, in the same week, multiple national banks around the world agreed to open up a US dollar swap line to provide additional liquidity, aka inject as much money wherever and whenever banks or businesses need it before they fail. It paints a difficult scenario that stock traders need to be prepared for. Now, if the Fed and other global banks decide to keep on hiking interest rates into this uncertainty, it will push the global economy to the breaking point, and multiple institutions are likely to fail. This isn't likely given the steps that have already been taken. More realistically, the central banks stop hiking rates and create a loose monetary policy environment, just like post-2008 and during 2022 and 2021. This means that our friend inflation will come roaring back along with volatility in the stock market. Here's how you can set yourself up for success as a trader in this type of environment. The simple way is to dollar cost fund your way into good companies or an index fund that provides you with some diversification of your risk. This also allows you to remove the fear that will be thrown at you by the media as you adopt a slow and steady approach. The more data you understand, the better your options are for creating winning trades. Don't give in to fear, invest more time in yourself, and build skills that can get you paid. And don't be surprised if the market starts to swing wildly. Stories will break in the news and have big short-term impacts on the market. Prepare yourself for such movements and learn to profit from them. I like to sell put options and get paid more when volatility is high. To learn more about what they are and how you can use them, even as a beginner trader, check that card out right there. Once the trend is established, and that can be either up or down, my bet is that initially the market's going to go on a heater because of all the extra money being pumped into the system, but take a portion of your profit. 3 to 5% would be conservative, and that's what you're aiming for here. Take that and then make big bets to enhance your returns while also managing some risk. And take notes about what's happening around you. Why is the market reacting a certain way? What cause and effect are influencing the trends? We as humans tend to forget the past, and we tend to focus on the immediate situations. A lot of money can be made if you can spot the signs now and remember them for next time down the road when history repeats itself. We have not seen the last of the action from the Fed, and given the way the global economy is built, drastic changes in policy could come sooner than later. Thank you for investing your time and watching this video. Subscribe if you want to keep learning and keep investing in yourself.